As much as we've been fretting about the wholesale declines in energy and metals, pretty much all commodities, the fact is that agricultural commodities have quietly been getting slammed over the past year, too. However, despite the falling prices of soy and wheat and corn and cotton, companies in the agricultural complex that have planned wisely and executed well have been able to deliver some solid performance. Take AGCO. That's the world's third largest maker and distributor of agricultural equipment like tractors and combines. Even as crop prices have come down, and they come down big time, AGCO has seen its stock rally roughly 16% year-to-date, dramatically outperforming the S&P 500, which is only up a little more than 1% for 2015. And this is despite the fact that AGCO sales and earnings have declined significantly year-over-year. Nevertheless, AGCO just reported this morning, and the company delivered a 25-cent earnings beat off of a dollar basis with in-line revenues. Even better, management gave a much higher-than-expected full-year forecast on both the top line and the bottom line. That's why AGCO was up more than 4% at one point this morning, even as the stock only gave up most of its gains, in part because the agricultural complex is still very much out of favor. But here's how I look at it. If this company can beat the numbers when crop prices are falling left and right, can you imagine how well it could do if ag commodities started to stabilize? So let's take a closer look with Martin Riesenhagen. He is the chairman and CEO of AGCO. To hear more about the quarter and his company's outlook, Martin, welcome back to Mad Money.
Jim, thank you very much. Pleasure talking to you today.
Martin, did it happen? I mean, you told us that there would be a trough, that you would buy stock into the trough, and now the stock is soaring. Is this the scenario playing out that you described to us?
Pretty much so. So that means the markets didn't help us. They were even more down than we were assuming. But we did our homework. We started early, and we performed above, as you mentioned, guidance and also consensus. And we can do a little better, we think, for the remainder of the year, because also our tax rate we could manage down a little bit.
All right, now you said production decline in 2015 is front-loaded. You are are you being optimistic about the second half, or have you just taken out so many costs that you just you're fine if things stabilize?
I think I'm more realistic. So I think in many markets, pharma do better than expected. Like in Brazil, which is a big market for us. We have plenty of factories and 50% market share. Farm income will be good because they are in a record harvest year. The real is not strong, so therefore they're in a position to do very well in exports. But due to the political environment, the farmers have a tendency to hold back investments. Same problem in Argentina. We heard a lot about Ukraine, Russia, some of the European markets. So overall, it's more related to the political environment than to commodity prices only.
Well, hopefully that means it's shorter term. Andy Beck, the senior vice president CFO, at one point says, we are seeing a stronger order situation in hay equipment and small tractors in North America. Is that an harbinger of something good, or is that just something one-off?
That's very good for us because in hay and forage, or let's say in the dairy industry, we have a pretty strong position with our Aston factory. Small tractors, we just launched a new range of products, so therefore, made in China, by the way, and therefore I think this normally should be good for us.
So, Menchai, your operational costs really dropped pretty severely in the last year, haven't they?
Yes, that's basically our focus. We need to make sure that we do it in a way that we also can come back as soon as the markets come back. I personally believe that they will come back sooner or later. The question is when. And if they come back, or they could come back big time. Like this is what I think could happen here in the US. So that means you need to be very cost conscious, but at the same time not damage your capacity possibilities.
So you're thinking that there could be great leverage here, because, you know, a lot of people have been bet against your company. 18% of the stock has been sold short. You have been an aggressive buyer of your stock. You've cut your costs. Is that the situation where a nominal increase in revenues could lead to gigantic earnings expansion?
Yeah, that's the idea. I hope so. I had a director who always was a former GE guy who always was saying, well, if the markets are back, you will see it raining through the roof. So that's what I'm hoping for.
I mean, we are making a case here on the show that if this is what you can do when things are this bad, and we don't think things can stay this bad because people still have to eat in this world, you can only imagine what your company can do when things get slightly better. And you sound like you agree with that thesis.
I do, yes.
And you will continue to buy back stock at these prices, or is that just only if the prices get back to where they were?
No, we are also continuing to do it at these prices. So we have a kind of program, and we do it in basically in reasonable portions. And I think my idea would be also to continue doing similar things in the future. So we have enough horsepower to be in a position to also renew a buyback as soon as this one has been completed.
Well, I think the ones who have bet against you are going to be sore losers. Martin Reichenhagen, Chairman and CEO of AGCO. Well done, sir. Well played.
Thank you very much.
Of course. Now, look, this is a man with great conviction, puts his money where his mouth is, buying back stock aggressively. And what's happened? The stock has been a winner. AGCO, I don't think it's done. Stick with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.